Hi, this presentation is about the factors influencing capital structure. I presume by now you would have understood what the composition of capital structure. For a quick recap, it's a combination of debt and equity, which helps acquire the assets in a business, and this is also called as the financing mix of an organization. There are two kinds of factors influencing the capital structure: factors which are intrinsic to an organization, which are called as internal factors. They are specific to an organization, and an organization more or less has a full control over those factors, which means they can change those factors if required. External ones are the ones which are related to the outside environment and factors, and business does not have much control over them. What are the internal factors? Some of them are listed here, and we will take each of them one by one. Size and nature of business. Nature of business, when we say, it means possibly businesses which are capital intensive, or businesses which are not capital intensive, or businesses dealing in various products. So it all depends. The mix of debt and equity depends upon the nature of business. Also the size. Small businesses, they find it really hard to raise capital from from outside. So they normally depend on internal capital, unlike big businesses, large businesses, where funding is easily available. Then is capital gearing. Capital gearing is also known as debt equity mix, which is also a combination of debt and equity. It depends on the balance between the debt and equity, which is required by a company. That's what is the capital gearing. Growth and stability. Obviously, it means at what stage of business the organization is in. If it's at the growing stage, its requirement of capital will be different than what it is at the stage of stability, when the business has acquired stability. Then the quantity of capital required may not be as high at the stability stage, and the ways in which it raises capital may also differ. Control means the extent to which a company wants to have a control over its management. When the company wants maximum control on its management, it prefers debt over equity, because equity dilutes control. Uh, Earnings and cash position means what is the cash position of the company at a particular point in time. If they are comfortably placed in terms of their cash, then they prefer going in for debt, because the interest servicing of debt is easy for them in that case. Growth of the firm. What are the expansion plans? If they have huge expansion plans, they go in for huge financing. Companies which are larger in size, they go in for equity and debt financing both. And it depends on the growth prospects. Period of finance means short term or long term finance. Period of finance is decided by the requirement of finance. If it's required for as a working capital, obviously it will be short term, and if it's required for expansion or any other new project, it is obviously long term. Leverage is more or less capital gearing. Leverage is basically again a combination of debt and equity, where how much debt will the company have, which is the leverage, by the way, is also called as trading on equity, which means how much debt a company will have on its books to leverage the returns out of equity. We have a full discussion on leverage in the upcoming slide, so I leave the concept here at this point only as of now. We look at the external factors quickly. External factors include the nature of the industry. I've already discussed a little bit on this in the internal factors also. The kind of industry that the firm is in drives the capital structure. Then the attitude of the investors, which means the risk-bearing capacity of the investors. If they are more risk-bearing, they would prefer to invest in equity, and hence they will expect a higher rate of return as compared to debts. Market conditions. Yeah, what are the conditions in the market? If the market is flourishing, if it's in boom, it's in recession, that defines the capital structure of a company. Government rules and regulations obviously play a huge role in the capital structure. Now, government rules and regulations could be for could be different for different industries, and so they can influence the capital structure to that extent. Competition, as in what is the trend followed by competitive firms. that drives the capital structure of the organization in question. Interest rates obviously are the interest rates prevalent in the market, and by that we mean the borrowing and the lending rates. If the borrowing and the lending rates are high, or rather the lending rates are high, the investors would want to lend more, but the borrowers may be unwilling to borrow as much money. So there has to be a balance struck between their requirements. Attitude of financial institutions. Financial institutions are the ones which provide loans or which provides external finance. It means the risk bearing capacity of the financial institutions, and the way they look at the credibility of the organization. Taxation policy obviously means the policy formulated by the taxation department, and that means for example, for a debt, the interest paid on a debt by a company is tax deductible. So that may possibly be a big driver in the companies asking for more debt than equity. That was one of the examples of taxation policy. So these are broadly the factors which affect the capital structure of a company. More in the upcoming slides. Thanks for now.